Okay, let's kick off. Good afternoon to all guests who have joined us today. I'm Luke Downs, UK and Ireland Marketing Manager here at Similarweb and the host of today's webinar. We'll shortly be diving into the topic of UK 2023 consumer trends, interpreting performance via data signals. But before we get there, I'm delighted to welcome Ines Durand, Senior Marketing Insights Manager at Similarweb. Ines helps global brands in the CPG and retail space to optimize their digital performance and grow their market share through the use of Similarweb's world-class data. In her time at Similarweb, she has contributed to some of our most prestigious reports, notably the State of E-commerce and US consumer spending reports. Today's presentation will be followed by a Q&A, so please feel free to ask questions throughout the presentation using the chat feature. I'll pose the questions to Ines at the end of the webinar, but until then, I'd like to hand you over to Ines.
Hey, thank you very much, Luke. Hi, everybody. Very happy to have you here. So let me take you through today's theme, which is consumer trends and business performance, and how to interpret this performance via data signals. So first, you ask me, what are data signals, digital data signals, what are the ones we're tracking? So let me show you different examples proving how they strongly correlated with the business performance, and that can help you detect the wrong strategies and poor execution. It's mostly crucial at that time where we have a high interest rate, we have lower consumer spending, and we need to capture these online customers at the lowest cost. Then I will explain to you how you can build a successful digital strategy if you're in a process of digital transformation, and what KPIs to monitor. It's not really about your own data, right? You already know everything about your performance, but it's about contextualizing it with your competitors. So today, we kind of changed the agenda from the original brief of the invite, as there's been recent interesting events that happened in the past month. So you know that there's been a lot of high street omnichannel retailers that suffered from the cost of living crisis, had to go into a bankruptcy process, such as Debenhams. But recently, we had Wilko, that recently announced they're stopping selling online, and they will only be selling in store until the stocks run out. And today we're going to have a look at the digital signals that could have predicted its downfall, especially analyzing the online business part. We noticed obviously some trends quite a few times ago, and I will show you exactly what data points to track to see if there is something wrong across your customer acquisition and monetization. Then we will move to the example of Shein, the fast fashion Chinese disruptor. I'm not presenting this again, but that is really shaking the UK apparel industry. And I'll show you their tactic and how the perfect marketing machine can work in customer acquisition and monetization, even in a downtime. So now just let's jump then to Wilko. So just to contextualize a little bit, we know that there was a peak in digital traffic for the whole industry, for the home furnishing goods and like e-commerce generalists in COVID. However, year after year, we've seen a decrease in traffic. The last 12 months, especially to July 2023, by 5%. So this cannot be attributed anymore to the return in stores. Stores were open now like almost 2 years ago. So it's pretty much, the effect of the cost of living crisis. However, the full category, the total traffic here to the industry is not revealing enough to help us understand what went on with Wilko. So let's have a look now at the converted visits part. Right now, I'm showing you the converted visits year-on-year change to Wilko competitive set. So the last 12 months to July 2023 compared to the 12 months before. What we're seeing is, let's start with the obvious. Wilko was not the only victim. It experienced a drop in 6% year-over-year in converted visits. However, some of its competitors, like the smaller or the bigger, experienced higher decreases. Amazon saw 12% year-on-year change in converted visits, Screwfix 20%. So it's not here, converted visits are not enough to understand why Wilko went bankrupt. And as I suggested in different media pieces, it was more a problem of profitability. So now let's have a look how different KPIs can help us understand whether your competitor is profitable or not. And let's have a look at different indicators. So I'd like you first to look at this indicator, which is the brand strength. How do we measure this? So on the horizontal axis, we measure the direct traffic, and on the vertical axis, the branded search volume. And then why are we looking at this indicator? In a recession, we want consumers to think about us first. We want to allocate our resources to customer acquisition or maybe to conversion rate optimization. We don't have a lot of money to spend in brand awareness for people to get to know our brand online. So ideally, if you're a big retailer, you want to have the highest level of direct traffic and branded search volume. Because Wilko is a multi-category retailer, it competes with very strong brand names in different sectors, and including here in the home furnishing space. If we're looking at their competitors, it competes with Argos, with IKEA, with John Lewis, with Dunelm, that have a way higher share of direct traffic, number. Something as well I'd like you to invite you to look at is despite its long presence, it's been in the market for 90 years now, Wilko, we're seeing quite a low level of branded search volume, and its ranges within the same range as B&M, The Range. And interestingly, these retailers are actually interested into buying the assets of Wilko. So let's see how the synergies can play out in the future. So that's the brand strength was one component to look at. It didn't have a strong enough brand online. Secondly, let's have a look now at the cost efficiency. Why? Because we know that the brand strength is now a lot. So Wilko, we'll see in the next slide, will had to invest some marketing budget to increase visibility. Let's see how efficient it was. And here we can see it was kind of a key reason for Wilko's downfall. So what are we looking at here? The cost efficiency of acquisition measured on the horizontal axis by the period over period visit change, so last 12 months vs 12 months before. And on the vertical axis, we're looking at the pay per click spend, so like how much they spend in paid search. And what we're seeing is that first, the investment in paid media was a bit under average of the category. So they spent way above average, under average, actually. They spent $2.9 million in PPC the last 12 months. Yes, for the average of the category, almost 14 million. So it's really low. Moreover, the marketing team already kind of figured out they were in a bad position a year ago because they decided to increase the PPC budget by 41%. So that's quite a lot in their budget. That actually resulted in a minus 5% decrease in traffic from the previous period. So, if you invest 41% more and get 5% less visits, one might argue you get a bad ROI. Moreover, if we're comparing to other competitors like B&M, that is pretty much a similar size, they only spent in the same period $14,000 and managed to grow 1% in visits. So we can see that some of the competitors were more efficient, they overspent, and that obviously affects, the sales and marketing line on the P&L, right? So now, but let's have a look. Let's be optimistic, and let's think that yes, they spend more, they got less visit, but they actually may be better than their competitors at converting these visits. Let's have a look. So in this table, I invite you to look at this is the converted visits and conversion rate for Wilko's competitive sets in the home and garden space. What we're seeing here is that Wilko, highlighted in red, actually had the seven conversion rates in its competitive among its peers, only converted 2.3% of its desktop visits, versus the double for Argos that sat at a comfortable conversion rate of 5.65%. So we're seeing that they've done something wrong. Not only they attracted less visitors, but they're also not converting the customers they're bringing despite a higher cost in customer acquisition. Another piece here of information that I'd like to add is so we had about 484,000 converted visits in the last 12 months online on desktop. And I might add that 21% of these converted visits came from paid search and display ads. So that means paid media. So that means even for 21% of these converted visits, it was quite a cost-intensive customer acquisition process, which probably as well impacted the profitability at the end. So maybe the assortment did not correspond to the customer's taste. Maybe there are other factors that didn't make the consumers convert. But in any case, we need to remember this low volume is a problem because delivery is a cost to an online business. They need high volume because they're selling quite low margin products, and that's pretty much impacted profitability. But so now let's have a look post-purchase at another factor that can help you assess your competitors' health and have an idea of their customers' lifetime value, which will be the loyalty and retention index. So here we're looking at this index on the horizontal axis. We're looking at the percentage of exclusive visitors on desktop, so that visited only one site, and versus on the vertical axis, the percentage of returning visitors. Why are we looking at this? So exclusive visitors is interesting to look at because in a downturn time, when consumers are financially stranded, they tend to engage in cross-browsing behavior to find the best deals. So basically, the higher the exclusive visitor share is, the lower is the risk of cart abandonment if the customers were to find a better deal elsewhere. So a high number leads to a bigger likelihood of purchase, basically. On the other end, if we're looking at the returning visitors, it's interesting because having a low share of returning visitors means you'll have a higher cost in consumer acquisition. If you have like a good share of like a high share of returning visitors, however, you won't need to invest a lot of money in paid search or in brand awareness. For instance, you can once again in a downturn allocate your resources more efficiently. So moreover, if you have returning visitors, obviously you have a better knowledge of their tastes or what they like to purchase or their like consumer journey on site. You can capture data. So at the end of the day, you have an increased chances of generating recurring revenue from your consumer base. One more piece of information I'd like to add here. So because we're seeing that they have among the lowest share of exclusive visitors. They're performing way worse than other competitors like Argos, John Lewis, IKEA, even Studio. Something as well I like to add is Wilko's visitors. If you looked at the cross browsing, the top cross browse sites, Wilko's visitors were more likely than last year to browse competitors' sites, especially the one in the DIY space. So the cross visitation, for example, between Robert Diaz and DIY and to DIY as well, increased by 11% year on year. So we see like once again a bigger chance of cart abandonment, etc. So that's why it's really interesting to look at this kind of metric to forecast performance. Now, before let's wrap up Wilko's case study, which was quite interesting in my opinion. Let's have a look at the app adoption. Why do we think it's an important metric to look at? In the digital world, you can't really afford overlooking digital transformation, and you need to offer a pleasant user interface, a user experience across all the devices to make sure you satisfy the broader range of audience, right? From 65 plus to the busy millennials who like want to shop from the tip of their finger on the train home, for instance. And what we're seeing here is that Wilko had one of the lowest at adoption. Only 3% of his digital customers are using the app. However, if you obviously other competitors are experiencing the same problem. Robert Diaz, I believe the name doesn't even have an app or like has barely any visitors. But if you compare it to BM Stores, Toolstation, they actually have above 200,000 unique users, unique app users a month. So if we compare as well, once again, another comparison to Amazon, that is also an indirect competitor of all these retailers on the charts, 47% of their users use the app. So it's extremely important vector of growth today in our digital world. and a KPI to monitor as well in order to measure digital success. So now, after we looked at Wilko's example, let's have a look at Shein. Why? Because I want to show you the example of a turbo growth as well, and how you can better keep your market share away from these big disruptors by observing the right KPIs. So why are we looking exactly at Shein? So obviously, it's a big player. I'm not going to present it again, but it's expected to take over both H&M and Zara in revenue by 2025, so to nearly $60 billion a year. So it's quite a big player. There's a second app in monthly active users in the UK fashion category. They actually have reached almost 12% penetration rates on mobile devices, so it's huge. They're one of the biggest sites in the fashion category, but actually there are conflicting trends at the moment as well, and that's why I wanted to look at this. It's because yes, there is a demand because of the cost of living crisis and stranded consumers for ultra fast fashion, but actually also for second hand. And so we'll have a look a bit on how maybe a second hand can also challenge Shein's position in the future. So first, let's start with the classic metric you can measure. You need to measure to forecast performance and to evaluate whether a player is doing better than you, the traffic. However, that time, try to go one level deeper and break it down by demographics. Why? It's because it's interesting to look at overall total traffic, but we all every single player has their target demographics, and you really want to understand whether it's just one demographics that is carrying the overall growth, or if it's the whole demographics. And here, what we're seeing, what is interesting, is that Shein, in opposite to what we say, and that it's mostly carried by Gen Z, it's actually conquered most age groups, and I was very surprised as well when I saw this stat, that Shein is also the third biggest players in visits for the 55 plus age group, right? It actually overtook Matalan for the 65 plus. So another interesting stat. However, we need to look at other metrics and traffic. So let's assess how big their brand is. So we know that I hope you remember this chart, the brand strength from the Wilko example. And the reason why, once again, we're looking at brand strength is because branded search volume is a good indicator of brand awareness and direct traffic of returning customers. What we're seeing here is that Shein actually ranks now third in direct traffic, just behind Next and ASOS, and actually even in front of Marks & Spencer, I believe. And Vinted actually comes fourth. So that's showing the breakthrough of the player in the mind of the customers, right? Interestingly, Shein is also ranking quite high in terms of direct traffic share compared to its competitors. Actually has the biggest. So 37% of its traffic comes from direct channel, and it's higher than Next that has 29% of direct traffic, and ASOS that has just below 37%. So it's quite interesting to see how they came from over relying on paid search and over these paid channels to relying as well heavily on direct traffic like traditional actors. There is also something to highlight, in a level of branded search. It's quite high considering how many years it's been on the market. Only about 8 years compared to H&M, Zara, etc. And what is interesting, it's really driven actually by social media and bad publicity. We've seen a lot of articles around Shein about complain about the ethical rights of the workers, etc. But actually, this is just driving brand awareness. And what I'm seeing as well, that was quite a funny example, is that if you're going on TikTok, the hashtag Shein accumulates about 7.1 billion views when I looked a few days ago. The hashtag Shein fails, showing the discrepancy between the products, the pictures, and the real product that arrived, has 7.5 billion views, so actually more impressions than the normal Shein hashtag. So it really shows that the virality of TikTok, even if it's bad publicity, at the end of the day, it is good publicity. So what I want you to take away with that is that from that is that competitors should be worried about falling so behind, as you'll see on the next slides. Because we know, so I talked quickly about the social media. We know that they're spending a lot of money with their Shein ambassador program. Unfortunately, this is not something we can measure. We don't have the numbers, the $1 million numbers contract that they're spending with them. However, we can assess the monetization efficiency from the social channel. And if we're looking at these charts, we have on the horizontal axis all the visits coming from social. Yes, on the vertical axis, the converted visits. We're seeing that Shein actually converts among the fast fashion players the most visits from this channel. So they're very efficient into turning influencer contracts into gold, basically, and into profits. And it's really pretty much a key factor of success for fast fashion brands nowadays to understand how to create a successful social media strategy. They're still getting less visit than ASOS, but they're actually converting better at 2.6% on the social channel. So now we had a look at like the monetization of these hidden investments. We cannot really measure, but let's have a look at what is the part of their growth strategy in the UK and elsewhere, the PPC, the paid strategy. So one important thing to take away, so this is once again the cost efficiency of the acquisition quadrant. So like with the period over period visits change here and the PPC spend on the vertical axis. Shein has the highest PPC spend among all the UK fast fashion players, even way higher than Next or Marks and Spencer, who are approximately spending between $8 and $9 million. Shein is actually spending $19 million just in the last 6 months, by the way, with visits growing 29% in this period. So for instance, for Next, that spent $8.3 million in the same period, they saw a decrease of visit by about 12%. So we can't really say that they were efficient in comparison to the Chinese fast fashion giants. So it's pretty much a growth-oriented strategy. And it's the only company, by the way, in the competitive set with positive traffic growth, beside for Vinted, that is, by the way, growing with only $500,000 budget, so just a 3% of Shein's budget and 11 percentage points faster. So it's quite interesting. So we see that over competitors, beside Vinted, ASOS, they're not really seeing a return on investments on this paid search, and they should really rethink the content and the consumers they're targeting for these campaigns if they were to spot this. So now let's have a look at the monetization efficiency of Shein's paid campaign very quickly. And if you thought they were just burning cash, like many companies, like Wilko, for example, that we've seen previously in the presentation, you're wrong. They actually outperform others in paid search in both the investments, and for most players also in conversion. Marks and Spencer actually is probably a bit more efficient than Shein into converting the paid media visits, that it has way lower investments. And is converting slightly more paid search visits. But still, looking at this kind of data, you will know as a competitor that you need to learn how to capture your audience more efficiently, maybe create the right content, improve the landing pages, understand better the pain points, means like the products you should be offering. Shein is quite lucky on that sense because it's leveraging AI, but yeah, so these are like few points to take away if you're looking at this kind of metrics. But now let's have a look at one interesting metric we can track to look at, the profitability. So you know that Shein is is owned by a private investor, doesn't publish often its results. So we don't know the margin. We just know how much they're spending in marketing on paid. We know that they don't have a cost of design or pictures, or it's quite low, as most of it is AI generated. But there is one thing beside the standard margin that we should consider, and it is the cost of bad customers. So here we're looking at the segment share of visits to the returns pages of Shein vs ASOS in the UK in the last 12 months. And what we're seeing is that the segment share of returns for Shein is quite low. It's below 0.55% of all traffic in the last 12 months versus 2 to 3% for ASOS. And actually, ASOS, in its latest financial statements, they disclosed that they identify approximately 6% of their consumer base were bad customers, and that it was costing them £100 million in profits. So that's that's once again an interesting way to really understand, to use this kind of data to understand profitability, to measure it, and to benchmark it. And this is what we're seeing here. I'm just gonna go to the next slide because we don't have a lot of time left. So to sum up, what are the data signals that you should track? Some of the data points you can track for your competitors and for your industry are paid media, online converted visits, branded search, and state of spend, or like keywords, audience size. These are like all the metrics we talked about. They're like actually very interesting, not only to benchmark your performance, not only to benchmark your overall traffic, but also look at more in-depth data points to assess overall business performance. But these are just two examples, and not everything must obviously fit in your business model. So if you're not a client yet and you're not familiar with our suite of solutions, we really propose you to be open-minded. And if you want to reach out to us, or not to me on LinkedIn, and run with us the exercise and look at the correlations between what you're seeing and the data, and set up the tracking. So you can really win the market, anticipate the uncertainty, and really understand whether you're benchmarking above or below, and like on these different KPIs, loyalty, share of returns, things like that. So I leave you with just a few points, just explaining what we're doing. What are key selling points, I guess, will be the fact we can measure, as we've seen during this presentation, the pre and post purchase behavior, not only if we are attracting and efficiently at a good cost customers, but also if we're monetizing them post purchase with loyalty and retention. We have a very full view of the markets. You can use our granular actionable insights in almost real time to really make sure you're not falling behind your competition. So thanks a lot for listening. Really happy to have you here today, and I can take your questions now.
Thank you so much, Ines. Again, just listening to the presentation and understanding actually the competitive Wilkinsons, it's not something that anyone really does to take a step back. But looking at Homebase, or particularly a DIY shed, IKEA, a furniture store, John Lewis, a department store, it's probably the widest, craziest bunch of competitors that I've seen against one particular store. And to see their demise is sad for the retail landscape in the UK. Yeah. Guys, this is a really good opportunity to get some questions in. We've had a few already, but please don't hesitate to use the Q&A function in the next couple of minutes to ask Ines a question. Ines, the first question that we have is, how do Similarweb measure converted visits?
That's a good question. So actually, the converted visits, because we track the URL, visually, our R&D team set up some tracking on the thank you page. So, when a consumer enters the website, makes a purchase, we are able to track the converted visits by tracking the number of thank you pages opened in a month. And then obviously this is not direct data, so this is all recalibrated, but that gives us an estimate for many websites in many countries on the converted visits, and actually in different sectors. It's not only in a state, like in the e-commerce space. We can do it for the travel, for the banks. We can do it in different use cases, basically.
Great, thanks, Ines. And this is a more broader question towards, I guess, the outlook for the industry or the e-commerce space in Q4. How do you see, I guess, the e-commerce space playing out in Q4 and then further into the start of 2024?
So obviously, I'm no magician. I don't have I don't have superpowers. But what we're seeing with the different recent studies that I've conducted in our data, based on the H1 data year over year, is that the whole e-commerce space in the UK is suffering from a massive decrease in converted visits. You know, the trends that we were seeing last year, you know, like decrease to convert to consumer electronic sites, decrease to fashion sites, is something that we'll see probably like carry on in the end of 2023/Q1. As you know, inflation has just started to slow down, and then there's still like this cost of living crisis. There's one thing though that I like to add is there are two verticals are actually doing pretty well. Surprisingly, it's the car parts online, as I guess consumers, you know, want to save money and they're looking to do their repairs themselves and save some cost of the repairs from buying themselves the pieces and not directly from their garage. One more sector as well, and like this trend that we're seeing still is a revenge travel. We still have I guess about 6% increase in visits to travel site this year. So that's and I guess that's something we're gonna keep seeing, you know, like consumers sacrificing some expenses and prioritizing others. One last thing I'd like to add as well is because of the cost of living crisis, we're expecting high interest for Black Fridays and all these end of season sales in order to anticipate Christmas. But I'm not that sure about spending, the overall spending. But I think we are expecting a big surge in traffic around that time.
Great. All right. Thank you, Ines. That wraps up the questions. There are no further ones outstanding nor coming in. So, Ines, just like to extend a huge thank you for taking time out this afternoon to talk to the audience. Guys, if you would like a copy of the deck, please get in contact with Ines or myself. We're going to send out a few communications post webinar, as we always do, just to give you really just a thank you and ways in which you can get in contact with us. A recording of the webinar, if you wish to share it amongst your teams, is soon to be uploaded to our YouTube channel. So again, please feel free to share that with your peers. And so all that's left is to wrap up and just say, Ines, a massive thank you to you, a big thank you to our audience, and we hope to hear from you soon.
Thanks to all of you. Have a great day.